Hi, it's Lee and welcome to the Tesla Economist. I've been investing long enough to realize just about anything can really happen when it comes to investing and the market. I invested in my first stocks in the early 90s. I was barely a teenager and used my dad's account. I was always drawn to stocks and investing. I found it exciting and would much rather own investments than stuff. So I've been around a little while and seen some crazy things like the dot-com bubble, although I wasn't in the market at the time, but I was after the crash and playing with various internet stocks. To name a few, one was the company Macromedia. I owned that when it was bought by Adobe. It's the company responsible for Flash in your web browser. I was also playing with options with them at the time. Another company was Overture, the search engine that discovered pay-per-click advertising and was bought out by Yahoo. Again, I had options and stock. Had some other stocks like Microsoft, but also bought AskJeeves.com at the bottom of the dot-com crash, now known as Ask.com. The stock went up about 50 times before it was purchased by IAC, and IAC went up about 30 times since then, around 2021. In case you hadn't worked out, that was 1,500 times return. However, we did sell out, taking profits as the stock rose, with only something like a 10 times return on average. But a good lesson nonetheless. A 20-year-old hold was not easy anyway. In fact, IAC didn't do much for the first 15 years either. Then I was holding stock when the global financial crisis hit, and actually dumped my portfolio early in that crash before it got much worse. We were mainly investing in real estate back then, in commercial property anyway. These first-hand experiences add to your own investing knowledge and know-how. I believe it's the best way to learn to invest. Find out what works for you. I've read so many books on investing, trading, hedge fund management, technical analysts, etc. And do you know what they are? Contradictory. A lot of them say the exact opposite to one another. One book says a certain strategy works, whilst another says the same strategy doesn't. In other words, you have to come up with your own strategy that works for you. The same as many things in life. You have to carve out your own way. Like dieting. You might try keto or something, lose a bit of weight to start with, but find it's not sustainable. You need to find the right balance for your lifestyle and your body. And the same for investing. You need to find the right investment strategy for your stress tolerance, aims and ambitions, your knowledge and your intelligence. I mean, some of these hedge fund managers have absolutely insane intelligence and can calculate massive equations in an instant in their head. It means they can see numbers different from you. It's likely you or I don't have that same skill set, so we can't use what works for them. You have to use what works for you. And you have to discover your own strategies. And this is how a lot of hedge funds work. The manager has some sort of strategy that is unique and ends up averaging 16% returns over a decade or so. There may be investors you listen to now, perhaps some that are waiting for Tesla to dip below $100 and then buy, although that opportunity is looking less and less likely, and that may have been an incorrect strategy, and they may be mocked for insinuating such a thing, except they may also be worth tens of millions of dollars, because in the past, this strategy has worked for them, and although it doesn't work every time, it's worked enough times. And that's just their strategy, one investor's. Then you probably listen to many others on top of that, but you should only be listening to them in order to mold your own strategy. Understand what and why a strategy is working for one investor and use that to enhance or experiment with your own strategy. And for all you know, this one investor may have just gotten lucky once, like a lot of these crypto millionaires. Now, a lot of you listening think you're so clever that you can beat Warren Buffett on investing over the rest of the decade and get substantially greater returns. Really? The Oracle of Omaha? Well, yes, you probably can. It's not that difficult, as long as you are an avid investor and have the experience and knowledge. Buffett's returns are handicapped because he is dealing with such large amounts of money. It's a lot easier to get a higher return on $1 million than $1 billion, let alone hundreds of billions. Buffett just needs to beat the index funds to impress his investors, and he has his way. In fact, a good analogy I like is about golfers. It tends to be the younger golfers that win the tournaments. Why? The older golfers can hit the ball further and more accurate, so why don't they win? Well, it's because the older golfers have more experience, and sometimes this experience can count against you. The younger golfers try and clear the woods or water hazards with one shot, whereas the older golfers are less likely to take that risk and shoot around it in 2 shots. Why? Because they have had too many times where they didn't make that shot, and their ball ended up in the drink or something. In all honesty, I actually don't know if that is true, but I read it somewhere, so it probably is, but I don't follow golf enough to back it up, and it's moot anyway. You get my point. Buffett plays it safe, with value stocks, whereas some of you are all in on Tesla right now, hoping or almost guaranteeing that you'll get about 3 to 10 times return on your investment by about the end of this decade, and think Buffett is stupid for not investing in Tesla, or sometime even speculating that he is investing in Tesla when the stock starts running. I also had the majority of my net worth in Tesla too, but only because it appreciated so much when I started. 20 times in just a few years. Who would have thought that? I didn't. I thought 10x by perhaps mid to late 2020s if things go well. Oh, but some people did, or were closer, like Cathie Wood, right? Yeah, she was mocked for believing in such a story, except it happened. She got crazy returns on Tesla with a huge investment, and then became extremely popular. People thought ARK was the fund to invest in, with Cathie Wood being the closest thing to a crystal ball. She was right, except not for the right reason. You see, for my forecasts, I predicted those returns solely on EVs. Back then, FSD felt to me too hard to believe, but EVs, I was sure would be the future. They were a better version of a car, plain and simple, and Tesla were going to get the costs down to $35,000 for one, with great margins. So I believed everyone would want one. Whereas Cathie, well, she was sold on the robotaxi and FSD potential, and her numbers all factored in those. She was totally wrong, except she was right at the same time, just for the wrong reasons. ARK's latest predictions again include robotaxis, so I think they are a waste of time. They don't know when they'll be solved, just like Elon doesn't appear to know. So how would ARK know any better? No one knows when FSD is solved. ARK got lucky because anything can happen in the market, and you can make asymmetric investments or bets, in that if FSD is solved, you make 10 times your money on Tesla. If fiat currency crashes, you can make 10 or maybe 50 times your money on Bitcoin. The potential upsides outweigh the downsides. But Warren Buffett doesn't invest that way. But his slow and steady compounding technique has obviously been a huge success too. Can FSD be safer than a human? How far are we in the March of Nines, like Elon tells us? Are we at 99.9% already? How are we measuring this? Is it an arbitrary way to measure? What about the number of journeys that don't require interventions? Are we even at 90% there yet? I don't think so. We may not even reach the first 9 in the March of Nines in that regard. And it's a logarithmic progress, not exponential. But I don't even have FSD, let alone FSD beta. I'm not an AI expert either. And like I'm saying, anything can happen. Some breakthrough, perhaps Dojo starts working and solves it within months. As far as Tesla, we've hopefully seen the worst the market and the economy can throw at it, at least relatively. The stock has remained resilient with its recovery. It took a while, and it would appear that Twitter had more effect on the stock price than the fanboys claimed, defending Elon's stance on free speech. And yes, it's great that we can tweet more freely now, but it doesn't change the fact it still hurt some of us and cost us millions of dollars. It's much easier to support the movement when you hold a few hundred shares and have decades to hold until you need to think about retirement. Twitter was like a black swan event for Tesla. Who would have thought that would have occurred? So with a stock as volatile as Tesla, there will likely be more ups and downs. But at least we got a good glimpse on how the market values Tesla through various scenarios and environments. Hi there, I'm using Verbalate AI video translation and lip sync software. It's pretty amazing. Watch this.
I can translate my videos into other languages. For example, I am now speaking Hindi.
नमस्ते, मैं पहली बार हिंदी में बोल रहा हूं, लेकिन Verbalate इसे इतना आसान बना देता है.
Or how about Spanish?
Hola, vaya, increíble.
También puedo hablar español.
Sign up at verbalate.ai today to gain early access to trial the product for creators and strategic partners, and gain the ability to translate and lip sync videos in all major languages. You can view the info in the description below.